Hi, and welcome back to the Business Career College video series. In a previous video, we had looked at the 5 C's of credit. And in this video, we're going to further examine a couple of those 5 C's of credit. So it may be worth a review of those 5 C's of credit before you watch this video. Now, this video will be most useful for those who are pursuing one of the financial planning designations, or just if you're interested in what it means for consumers to access credit or how consumers access credit. So just as a quick recap, we had looked at capital and character and conditions and capacity and collateral. So not to point to any of these as being more important than any other, but there are a couple that consumers can directly impact or maybe more directly impact than others. And those are credit and capacity. They're the easiest two to measure generally, and they're the ones that we can understand most easily. When a consumer is having trouble borrowing, those are the two that you're most likely to be able to fix. So character, first off, is measured through the credit score, or the beacon score, or the bureau, or whatever we refer to this as. And basically what your credit score does, it gives your various creditors a chance to report on how you service your debts. So your creditors are going to report on how creditors service debts. Now, there are numerous things that can impact your credit score, or numerous things we're going to see on a credit score. So, for example, are you up to date on all your various debt servicing requirements? And generally, one missed debt servicing requirement doesn't cause a problem with your credit score, but a second one generally will. And then we're going to look at the amount of credit you have available and the amount of credit that you have accessed. So we're concerned about how much is available and how much of that you have used. Most lenders will consider the amount available as the amount that they're concerned with. The amount used is generally of lesser concern. So the things we're going to look for in a credit score then is somebody who's got a history of servicing debts. So I need a history here of having credit and using that credit responsibly. Now, we can have some potential problems here. So the obvious problem is simply that you have bad credit. Now, what if that arises? What if you do have bad credit? Well, most folks in this business will tell you that the easy way to fix this is not to ignore your creditors. So if somebody has bad credit, deal with your creditors. Reach out to those creditors, explain the situation to them, come up with a payment arrangement, stick to that payment arrangement, and that can resolve an issue here. Now, other things that can arise here, other problems that we can see, would be maybe a case of mistaken identity or some sort of error. The credit bureaus are not perfect, and sometimes you'll even have maybe an example of identity theft. And this is a good reason why people should keep an eye on their credit. Most of the credit bureaus will allow, the credit bureaus that are active in Canada anyways, will allow you to access your credit report on a consumer basis once a month. Now you have to be a little cautious because that doesn't give exactly the same credit score as what a lender will see. Lenders get a more refined version of your credit report, but it still will give you an idea as to whether or not there are errors on your bureau. Now, other things that can happen here is when we look at the credit score, one of the things that affects your credit score in the short term anyways is hits. So somebody who goes out and applies for numerous credit cards or different types of financing arrangements is going to find that that could create create a problem for them. So this is where you generally don't want to apply for credit until you know you're going to need it. So those are some of the issues that can arise around credit, and you'll find numerous articles concerning credit and quality of credit, what constitutes good and bad credit, and so forth. But there's some basic items that we should be concerned with. And then the other item that we will address here is the area of capacity. Now, capacity, we're going to specifically look at two ratios here. We're going to look at your gross debt servicing, or your GDS or GDSR, your gross debt servicing ratio, and we're going to look at your total debt servicing ratio. Now, these are most often used when we have housing or housing-related borrowing, so if you're using a mortgage or a line of credit, but that's not the only place where they're used, and most lenders who are dealing with especially secured loans are going to look at your GDS and TDS, even sometimes with unsecured loans. And it's going to depend on the dollar amounts and so forth. So your GDS, the way we calculate GDS, it's typically done on a monthly basis. And what we're simply going to do is we're going to take into account your housing costs. And that's going to include three major items. We incorporate principal, interest, and your property taxes, so all the costs associated with owning a house, plus any heating costs, that's the particular utility that gets included here, plus your condo fees if you have any. We would also add in 50% of condo fees. And we divide all of that stuff by your gross monthly income. That is your before-tax income. And what we're looking for here typically, and it depends on the lender, but what we're generally looking for here is a ratio somewhere between about 25 to maybe as high as 35%. That would be an exceptionally high GDS. Usually, in fact, it's going to be somewhere around 30 to 32% is going to be the typical GDS, but as we discussed earlier, conditions will affect that one way or another. Now, when we look at your housing costs, there are some items we have to understand here. So when we're calculating your principal and interest, regardless of what mortgage you're actually applying for, lenders are required to calculate this when you have housing-related borrowing. Lenders are required to calculate this based on their their posted 5-year fixed mortgage rate. So you may actually be using a mortgage that's cheaper than that, but we still have to qualify for that mortgage based on this posted 5-year fixed mortgage rate, even if your actual cost of borrowing would be less than that. Now, when we do a total debt servicing ratio, we're also going to add another item here, and the other item we're going to add would be all your other debt servicing requirements. So this is where you would include your credit card bills, any car payments, and any other debts that you might have. So we're looking at credit card bills, if you have a minimum payment on a line of credit, if you have a car loan, all your various debts. So not your total range of financial obligations, but any of your debt servicing requirements, and still we would divide that by your gross monthly income. And that total debt servicing, the targets here tend to be somewhere in the about 35 to about 44% range, typically around 40%, but it can push up or down again depending on conditions. So I hope this helps to understand your debt servicing ratios. One thing I should mention is that it is possible then to fix your debt servicing ratios. You have to be a little bit cautious about this because sometimes some of the things we do to fix debt servicing might affect your credit score, but you can fix your debt servicing ratios, again, as discussed, by negotiating with your creditors and making sure that your creditors understand your situation and that they're going to work with you. They don't want you to go broke. They don't want you to be bankrupt. They want to get the best possible return they can get on the money they've loaned you. So you might find that it's possible to negotiate with creditors, for example, to somehow reduce or fix these. Reduce or fix these. And you might find that somebody who's very familiar with this process, and you'll find this sometimes with a good financial planner or somebody who works in the banking system, which can of course include a good financial planner, or mortgage brokers are often very good at this kind of thing, where they will have a good idea about how we can get lenders to maybe be a little bit flexible here and reduce your debt servicing requirements so that then your GDS or TDS, your TDS specifically, will look more favorable. So I hope that helps. This is something that you'll need, as I said, in a financial planning course, but it's something that's often of interest or of concern when we're dealing with consumers who are trying to borrow money. So I hope you enjoy your ongoing studies, and please continue to join us. Thank you.